So, this is what we know about Alibaba so far. I realized that despite trying to provide updates around the company on a timely basis, information seems to be rather scattered all over the internet. And I know that many of you don't have the time to keep up with every single video that I put out, even though I greatly appreciate those that do. So remember to gently tap that like button so that this video don't get lost on YouTube. Therefore, this video will just be a rough consolidation of all the factors that are pulling Alibaba apart today. I'll split them up into 3 different categories: fundamental reasons, non-fundamental reasons, and lastly, it's the grey area. So I'll kickstart the discussion for non-fundamental reasons first. So, the delisting risk definitely takes the cake for being the first on this list. So this travesty was first introduced back in 2020 by then President Trump, and till today, people are still flirting with this probability of a delisting. To me, I have treated it as a fact. My assumption is that Alibaba, or Chinese stocks by and large, are going to be delisted. It doesn't matter, period. Sure, when the delisting were to really occur, there will definitely be massive amount of selling pressure, mostly by foreigners who might not want to own Hong Kong listed stocks or Hong Kong dollar exposure. I understand, but it doesn't affect my investment decision. I'm not going to wait on the sideline and wait for the probability of something like that to happen. If it doesn't delist, good for everyone. But if they do delist and the stock gaps down, you cry a little and then you buy some more. So nothing too difficult right there. Number 2, the straining relationship between China and the United States. So expounding on the first point, we know that the world operates on leverage between people, between countries. So kickstarting trade wars, boycotting of events, pressuring financial markets are just extensions of the same monster. So Alibaba and friends definitely experienced their fair share by being in the crosshairs of the battle between US and China. But Alibaba seems to be the face of China. So moving forward, I don't think the relationship is going to see a significant improvement for the better, at least in the short term. So especially when the 2022 elections is coming, and whoever pokes the bear earns extra brownie points. That being said, let's not forget that since we are investing in a company, it shouldn't matter much in the long term. So based on the last quarter earnings results, Alibaba actually generated 71% of its revenue from their China commerce alone. So despite having international commerce sitting at 7% of its revenue, most of their international exposure is congregated in Southeast Asia, and your dropshippers from the Western world won't stop buying from Alibaba or Taobao just because your politicians are taking a jab at the bear. In business, only profit matters. In the short term, fund flow will severely impact the stock price. And as we can observe, when Alibaba had a drawdown from its $300 at its peak, $70-odd. So within a short span of time, Alibaba's market cap went from $200 billion to $290 billion again. And that is just classic institutions playing with retail investors. And these sorts of movements are essentially crazy, but you should be happy if you are in the accumulating phase. So these US listed Chinese stocks will continue to be a hot button issue that the government continues pressing, so don't expect it to end so quickly and easily. Number 3, the VIE structure. Yes, this risk is inherent in all Chinese stocks. I'm not going to even bother sugarcoating it. It's either you're comfortable or you're uncomfortable. We don't need to have an extensive debate over it because it's all on the basis of what ifs and what nots. All the noise around these are made by people that probably didn't even study the country or the law. I'll leave the link in the description box down below where Crane Shares got a top Hong Kong private equity lawyer to opine on this issue. I believe you're grown up enough to do your own due diligence. I don't need to hold your hand. Another way to look at this is via inversion. So why would they want to invalidate the VIE and rug pull investors? What are the ramifications? What's going to happen to the world and their responses to it? You make your own decision. Now, moving on to the fundamental reasons. Firstly, the entire backdrop of China don't look good. The Chinese economy seems to be slowing down significantly, with a GDP projection at only 5.5% for 2022. So with headlines doing what they're doing best at, it's the lowest GDP growth target in 30 years. Coupled with experts calling it an ambitious target, naturally, it leads people to the conclusion that the Chinese economic miracle is coming to an end soon. So I think there are no two ways about it. Either you still believe that the Chinese miracle is still intact, or you don't. Personally, being invested, I still believe in their story, and this blip will just be a short-term transitory problem. I'm not here to convince you otherwise. The strength of the Chinese economy is instrumental in Alibaba's continued success, especially small-medium enterprises and its middle class. So if you think that the dragon has lost its steam, then okay, goodbye. Number 2, Alibaba's top-line revenue growth shows significant slowdown from previously 30+% year-on-year increment to recently only reporting a 10% year-on-year growth. So I think out of all the different commotions out there in today's market, this is probably the most legitimate concern that should be addressed. It's true, Alibaba's China commerce vertical is clearly in the maturing stage of the curve. However, I think it is also slightly unfair if we don't consider the other 3 verticals that Alibaba is trying to expand into today, which are its logistics capabilities, its international commerce arm, and its cloud computing arm, which all grew in 15 to 20% clip. Yes, because a bulk of their revenue is still attributed to its core commerce function, the other segments of the businesses are seeking their own growth curves, and that's what a compounder do, right? They seek additional growth. Expand its business, find new curves, and compound internally. Naturally, to point number 3, it seems like Alibaba is slowly losing its market share and market dominance position. Their margins are shrinking and earnings are hit by a large extent. So this company is essentially eroding from the inside. So I would largely disagree with that statement. Let's not forget about the backdrop of China and the nature of the competition due to the slowing growth in pie. Slapping new regulations of the industry in terms of data privacy, algorithm recommendations, and data collection, I don't think they are necessarily faring too badly. Alibaba is also currently engaging in a moat digging exercise, while reinvesting most of its cash flow and expanding its value proposition, which is translated to shrinking margins. So I do acknowledge blemishes such as heightened sales and marketing costs in their quote-unquote desperate attempt to fight off competition, but I don't think this is a sustainable business practice in the long run, and their competitors know it as well. Currently, with the lack of backing of huge conglomerates and the lowered interest in venture capitalist space supporting those tech startups, I don't think they can continue this cash burning exercise for long. So this is my view, of course. What do I even know? But that being said, if American companies are investing back into itself, it's a great exercise. 2 thumbs up to them. If it's a Chinese company that is reinvesting back into its business, the management team clearly don't know what they're doing. Lastly, the grey area. It's the grey area for a reason. First and foremost will definitely be the regulatory uncertainty. Will there be any more crackdowns or regulations? Will there be a mandate for common prosperity donations? Will there be a breaking up of the different business verticals? So many questions, so little answers. So it's a question mark for many investors, and both bulls and bears don't have an answer to this. Logically speaking, I think bulls are not as worried as bears based on what has transpired thus far. After multiple quote-unquote crackdowns, we can see the results being translated to earnings and to its growth. Of course, if you want to take the argument to the extreme, you can say that, hey, the CCP will be irrational and illogical. As long as you're happy, I'm happy for you. Number 2, Alibaba's execution and capital allocation skills are a little iffy now. Although Alibaba's historical ROIC hovers around 7 to 10%, which is decent, and they managed to execute well enough to be the market leader for 3 out of the 4 industries that they're currently operating in, the worry that most investors have is the execution and allocation risk moving forward. So there is this huge overhang on how government intervention is going to influence and manipulate these conglomerates, and this remains the largest variable that could not be quantified. So is the CCP out to kill? Only time will tell. And I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!